Walk us through how you're thinking about the next 6 months. Obviously, there are starting to be some greater concerns about whether the U.S. consumer can weather this storm. Let's say we see that kind of hike in rates, and obviously people are feeling the pinch in their pocketbooks. What's the wild card for you as an equity strategist?
Well, I can't say it's just one wild card at this point, John. I think it's all the factors put together. Now, we know with inflation, it's definitely taking a bite out of people's spending power. When you have that inflation, your real purchasing power gets decreased. And also, you're seeing that people are becoming more price conscious, and they're seeing and they're feeling those energy prices, the food prices. On the other hand, too, remember that equities are a large part of household wealth. Almost 25% coming into this year of household wealth was tied to the equity market. A lot of that was accelerated during the pandemic when we're all stuck at home and people got involved in stocks. Now with the market an official bear market, you have to imagine the possible impact it has on household wealth there. I think that's another factor that we want to remind investors. So as you see the consumer weakening, and as you also see other impacts that are outside really of our domestic control, these are all factors that could lead to less spending, less earnings growth, which also gives it a tougher time for the equity market.
And I want to ask you about what is actually driving the market here. For so long, it was operating margins, then it kind of turned into a valuation story. How much of the story right now is liquidity, and how much of that is going to continue to be the story in the face of quantitative tightening?
Well, that's a great point you bring up, that liquidity aspect. When you see a lot of volatility, people start moving their books around. We've seen a lot of rebalances shifting what is considered value style, what is considered the growth style. For us going forward, we're focusing on low volatility. We think that as you see slowing corporate earnings growth, a place to be is more defensive stance. And a lot of that reopening trade, the cyclicality we liked coming into the year and for the last year, I think a lot of that's been played out. I do think that people will still consider spending on services and travel, but it won't be as robust as we saw it in last year. So for us, pivoting towards more low volatility stance, looking at those stable earners and stable price growers, I think that's what we're preferring for our portfolio right now.
And real quickly, Anna, just on the areas where margin pressure could be greatest, what are the sectors you're going to be watching closely?
I think where you're going to see margins really come in is that combination of items that consumers don't really need, that really rode that pandemic lockdown. And now in the discretionary sectors, not a real focus for people to spend on top of the issue with continuing supply chain problems. I think those are the kinds of markets we would avoid. Also, that low quality parts of the market, companies that have high leverage, that have high volatility. Look for these more across the spectrum than necessarily focusing on just sectors. That would be my recommendation.